Oh, okay, good. We're recording now. Hey guys, welcome back to another Strategic Investment Club meeting. This is probably going to be one of the most exciting lessons. It's about taxation, also known as theft. This is definitely the last step of your education. Luke, if you can click the next slide. We put this image here to kind of personify your newfound freedom. Once you know the taxes, you can start doing loopholes and hopefully, fingers crossed, fraud. Kidding. Don't do fraud. But seriously, we're really proud of all the progress you guys made. And so, yeah, we're just going to get right started. Luke, you ready?
Yeah, this is exciting. This is one of the last skills you'll need to be able to do it all on your own. We've taught you how to set up an account, how to properly invest, how to research, how to think about what you're doing, how to look for value investments.
Yeah.
Don't be stupid.
How to
Um,
take losses like a champ.
like a
We talked
champ,
about
like
everything.
a champ. It's a
Yeah.
learning experience. You'll be a bigger person after every loss. So just take as
Seriously.
many as possible.
All right, let's keep it going.
Okay, overview. In the United States, you are required to pay taxes on your income. The amount of taxes you pay depends on your tax bracket, which I'll be getting into shortly, and the type of income. As of now, your parents are most likely filing your taxes for you if you have income from a job or something. And this includes gains on your custodial brokerage account, although that is a subtype of income tax, the capital gains tax, which I will also get into shortly. And the income there is only applicable if you sell your shares, and even if you do sell your shares, it's very simple to file taxes on just the basic investments that you're likely doing right now. However, when you become an adult, you are required to pay taxes on your own. I know it sounds difficult and scary, but it's not as bad as you think. Shoot. Especially earlier in your adult life, you won't have too many assets or income streams, so it shouldn't be too much of a challenge. Also, your friends and family will be able to back you up, as will services like TurboTax is a really good one that I know a lot of people use to help them with their taxes. So how much tax you pay on your income is determined by a tax bracket. So as you can see here, different ranges of your net income determine what percent of that income you will be paying to the federal government. And there are two types. There is earned income, which is all income from employment, including wages, salary, tips, and net earnings from self-employment. And then we've got unearned income, which is going to be the primary focus of today. And that is defined as income from investments rather than work. And it is subject to less severe taxation.
Yeah.
So,
Also, it's really important to note that like the 10%, 12%, like all of that, it isn't a total on your overall income. It's levied. So from 0 to like $9,875, you will be taxed 10%. And then from your income ranging from 9,876 to 40,000 whatever, you'll be taxed 12%, etc. So it's a little bit merciful. So yeah, don't be scared. You're not going to be taxed like insane amount.
yep, yep. I'm not going to go too deep into that. But I hope you get the picture. Like for example, if you're making $518,000, if you make $200 over that, 37% of that 200 will be taken, not 30% of the 500,000.
Perfect. Yeah.
So this is the real meat today, which is the capital gains, which is a form of unearned income, which you did not work for it. Your investment worked it. Um, so it is also subject to a tax bracket, as you can see here. And it's really important to know that your capital gains taxes are a subset of your income taxes, meaning that your bracket is determined by your total income, which we saw before, not just the income you make from unearned capital gains. So let's say that you worked a job and made $20,000 a year, then you would be in 9,500 to 38, even if you only made $5,000 from investing. And the keyword here is your income. So right now, as a minor, you have your own tax returns, and your tax bracket is not your parents' tax bracket. It is your income and your capital gains. And you'll see here short term versus long term. In the next slide, short term capital gains tax is paid on profits from assets held less than 1 year. And that's subject to taxation of 10% to 37% based on your tax bracket. I'll go right back in a second. And then long term capital gains tax is paid on profits from assets held more than 1 year. So,
Yeah, Luke. And if you even want to go back, just like a bit of strategy, most of you guys are probably not dealing. Go back to the nice little.
shoot.
There we go. Almost. Yeah, yeah, yeah. Most of you guys aren't going to be dealing with like tens of thousands of dollars. Probably you guys are working at like, Newton Center or at camp. And so you probably have like a couple $1,000. So that means you guys are dealing with a 0% long-term capital gains tax rate, right? So when making these investments, you definitely want to think long-term because no one wants to pay taxes and 10% adds up in the long term. You know what I mean? So make sure you keep that in mind when you're investing and you're not just like spamming day trades trying to like predict jumps. But
Yep.
we'll get into that later too.
They'll get you with the taxes if you're not careful.
No, they will.
So, especially for you people that don't want to do extensive research and be trading every other week, if you get a couple really good investments that you're proud of and then hold them for over a year, there will be 0% taxes on those when you eventually sell them.
Like the safest, relatively safest option is you could put your money in like a VTI, you know what I mean? Which is basically an ETF. We've talked about this, and you're gonna get 10 to 11%. And if you hold it for a year, right? Essentially, not only are you not paying the 10% for taxes, but you're getting 10% back. That's just like easy money. You don't even have to think about it. You can put it in there and then close your eyes. You can forget your password. That money's going to be there every year.
Mm-hmm. Great, great. All right, and now losses. If you lose money on an investment, the IRS will allow you to write off your losses from your capital gains. Um, again, whenever I add a new piece to the puzzle, it sounds scary and more complicated, but you shouldn't be too worried. Unless you're doing really crazy stuff, then your taxes really won't be too complicated, and it's really worth writing those off because it's free money. It saves you money. One caveat to this is the wash sale rule, which prohibits you from selling for a loss within 30 days of a purchase and then buying something else. It's not like someone's going to stop you from doing this, like it's totally illegal. But those losses are not deductible from your capital gains. So it's just that money's gone.
And an important note is if you have like a brokerage like Fidelity, they'll actually let you know if you're breaking like good faith or you're doing stuff like this, they're actually very helpful. They'll put little notifications when you start buying, they'll let you know. And a lot of these tax rules are on like brokerage accounts like Fidelity. I don't know if they're on like Vanguard or not because I don't use it. But personally, if you guys have Fidelity, take advantage of their services. They give you a lot.
Hmm. And then, should your losses outweigh your gains, which will mean you did a lot of learning and you're a really great person and a great investor. Should you find yourself in that situation, then you can actually deduct your total negative capital gains, your total capital losses from your income taxes actually. And then dividend taxation. Um, if you buy a stock with I really hope this isn't going to discourage you from buying a dividend stock because again, I'm adding another piece to the puzzle and taxes sound scary and complicated, but they're not. If you buy a stock with dividends, you need to pay taxes on this extra source of income. But dividend stocks are still great. Do not let this discourage you. I know it's scary.
And to
Um,
remind you, a dividend is basically like a constant you're going to get just by buying the stock. For like some companies, it's 1%. For some, it's like 5 to 10%. Um, Basically, it's a guarantee you're going to get money back. And when there's a guarantee, the government's going to line their pockets and take it. But don't be scared because having guaranteed money is still safe investment. And we can talk about the pros and cons. But yeah,
yeah, and the dividends are often paid out quarterly or annually, depending on the stock.
yeah.
So there are two types of dividend taxation, and that is on unqualified dividends, which are dividends from assets which you've held less than 61 days before paying your taxes, And income from unqualified dividends is subject to your normal earned taxation income rate. So that's like for the first, I'll go back actually. It's this tax bracket here, which is for the earned income, wages, salary, tips, net earnings from self-employment. So it's like standard income taxed higher than capital gains. And then for qualified dividends, which are dividends from assets which you've held for 61 days or more before paying your taxes, income from qualified dividends is subject to your long-term capital gains tax rate. So if we go back, you'll remember that's 0% as long as you aren't making crazy money right now. So make sure to hold on to those dividend stocks. And finally, to wrap up, I'm not going to dive super deep into these right now, but there are tax advantaged accounts, which we've talked a little bit about in the past. I know we went over the Roth IRA, some
Yeah,
really good stuff there. I'll try and link that presentation if possible. Um, but yeah, outside of your personal brokerage account, there are numerous tax advantage accounts with different restrictions and perks that allow you to make the most of your money and lose the least in taxes.
for sure. And these are meant to help you. Like these accounts here are really good. Uh, there's definitely some strategy that goes into it, especially if people of our tax bracket. Might be smarter to go with a Roth IRA or a 403b, especially if kids who are getting employed in college. But again, these are meant to help us rather than like screw us over. So we'll go over that. We'll link that presentation.
Yeah, awesome. I hope you
Oh, perfect.
enjoyed getting this final piece. I think you can do it all now. Um, but yeah,
That's you.
awesome job this year and take care.
Yeah. See you guys.